Welcome to today's video, where we break down a critical money choice. If your auto loan is sitting around 8.75% or higher, should you pay it off or refinance it? To set the stage, we will explore guaranteed return thinking, the power of lowering your debt-to-income ratio before a mortgage, and a practical action plan to choose confidently. As we move forward, we'll run real numbers and compare strategies side by side. Additionally, we'll finish with a couple of quick quizzes to lock in your learning. Finally, stay tuned to the end for key takeaways and a creative call to action. First, we'll outline why making the right move on a high-rate auto loan matters, especially if you are preparing for a mortgage. Next, we'll explain the guaranteed return idea behind paying off high-interest debt. After that, we'll layer in the critical rule about maintaining an emergency fund. Then, we'll look at refinancing pathways, especially through local credit unions. Furthermore, we'll connect the decision to your debt-to-income ratio and mortgage approval odds. Subsequently, we'll run illustrative numbers and present a practical step-by-step plan. Lastly, we'll wrap with short quizzes to reinforce the most important points. Before we dive deeper, a brief disclaimer. This video is for educational purposes only and does not constitute financial advice. Your personal situation, credit profile, and goals are unique, so please consult a qualified financial professional for tailored guidance. As we proceed, remember that rates, terms, and approvals vary by lender and borrower profile. Also, the example numbers shown are illustrative and may not reflect your exact scenario. With that in mind, let's continue to the core concepts. Now, let's consider why high rates hurt. When your APR is around 8.75%, a significant portion of your payment goes toward interest rather than principal, especially early in the loan. This dynamic increases your total cost of ownership and ties up monthly cash flow. In turn, reduced cash flow can delay or complicate larger goals like buying a home. Meanwhile, the psychological drag of a large payment can also discourage consistent investing or saving. With that context in place, we can better evaluate payoff versus refinance strategies. Next, let's talk about the guaranteed return mindset. When your auto loan interest rate is around 8.75%, every dollar you put toward principal effectively locks in a return equal to that rate because it prevents that interest from ever accruing. If your current investments cannot reliably and safely exceed that return, directing surplus cash to debt payoff can be the more prudent move. Importantly, this approach is guaranteed in the sense that the interest avoided is certain. But recall the caveat. Never deplete your essential emergency fund in pursuit of faster payoff. Stability must come first, because emergencies happen, and the cost of borrowing during a crisis can be even higher. Meanwhile, let's anchor on the emergency fund rule. Aim to hold 3 to 6 months of essential expenses in liquid savings before accelerating any payoff plan. If your emergency fund is insufficient, continue making your required auto payment while diverting surpluses to rebuild the fund. This prevents the need to rely on high-interest credit in a pinch. Once your safety net is set, reassess the payoff versus refinance decision. This sequencing helps you avoid trading one financial risk for another. Now let's compare payoff versus refinance. Paying off the loan immediately eliminates interest at a high rate and increases monthly cash flow right away. This simplicity can be especially valuable if you are preparing to apply for a mortgage in the near term. However, it requires significant cash on hand and should not compromise your emergency fund. On the other hand, refinancing can meaningfully reduce your rate, often into the 4 to 5% range, particularly at local credit unions, lowering your monthly payment and total interest while preserving your liquidity. Be mindful, though, that extending the term can increase lifetime interest, and refinancing may introduce small fees. Evaluate both options against your timeline and goals. To make this concrete, consider an illustrative remaining balance of $25,000, with 48 months left at 8.75%. Under the current loan, the estimated monthly payment is about $619, and total remaining interest around $4,712. If you refinance to approximately 4.5% for 48 months, the payment drops to about $568, and the total interest to roughly $2,273, often with minimal fees. Paying off today reduces the monthly payment to zero and eliminates all remaining interest, but requires the full $25,000 upfront. These figures are approximations for educational purposes. Your actual numbers will vary based on balance, term, fees, and exact rate. Next, here is a simple action plan. First, Verify that your emergency fund adequately covers 3 to 6 months of essential expenses. Second, request your exact payoff amount and remaining term from your current lender. Third, solicit multiple refinance quotes, prioritizing offers from local credit unions which often provide competitive rates. Fourth, compare each option on total interest cost and monthly cash flow. Fifth, decide. Pay off if doing so preserves your emergency fund, otherwise refinance to a lower rate. Sixth, if you refinance, try not to extend your term unnecessarily and evaluate any fees. Finally, if you pay off, redirect the freed up cash flow into rebuilding savings and funding investments. Moving on, let's connect this decision to your debt-to-income ratio. Mortgage lenders weigh your monthly debts against your gross income, and a lower DTI strengthens your application. Eliminating a large auto payment can meaningfully lower your DTI and may increase your qualifying mortgage amount. Even if you cannot pay off the loan today, refinancing to a lower rate and payment can still push your DTI in the right direction. Consider channeling the freed cash flow into your down payment, closing costs, or reserves. A stronger profile can improve both approval odds and the rate you're offered. This sequence diagram will depict the flow from evaluating your emergency fund and budget to gathering payoff and refinance details through to comparing total interest and debt-to-income impact. It then branches to two outcomes. If you pay off, the auto loan closes and your DTI improves immediately by removing that monthly obligation. If you refinance, your payment decreases and your DTI improves more moderately. Finally, the mortgage underwriter assesses your improved DTI and makes an approval decision. This journey emphasizes how both payoff and refinance can strategically position you for a mortgage. Question time. When is it generally unwise to accelerate auto loan payoff, even at 8.75% APR? Options. A. When your emergency fund is below 3 months of essentials. B. When you can earn a guaranteed 9% return elsewhere. C. When you are not planning to buy a home soon. D. When credit unions offer a 4.5% refinance. You may pause the video now to think about the answer. Is buy. We will discuss the answer in the next section of the video. The correct answer is A. If your emergency fund is below 3 months of essential expenses, it is generally unwise to accelerate payoff because a surprise expense could force you back into high-interest borrowing. Building a stable safety net should take precedence. While choices B, C, and D may influence timing and strategy, the emergency fund is the foundational risk control. Next question. How does eliminating a large auto payment typically affect your mortgage prospects? Options. A. It increases DTI, hurting approval odds. B. It lowers DTI, often improving qualification and terms. C. It has no effect on DTI. D. It only helps if your credit score is above 800. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Eliminating a large payment lowers your debt-to-income ratio, which typically improves your mortgage qualifications and can help with better terms. Even if you do not fully eliminate the payment, refinancing to reduce it still nudges your DTI in the right direction. While credit score remains important, this effect does not require an extremely high score to be beneficial. To consolidate learning, remember these points. High-rate auto debt is expensive and calls for decisive action. Paying off is akin to securing a guaranteed return equal to the interest rate, but only if you preserve your emergency fund. If payoff is not feasible without jeopardizing savings, pursue refinancing, especially with competitive local credit union offers in the 4 to 5% range. Reducing or removing the auto payment can materially improve your DTI for mortgage purposes. Above all, run the numbers and compare both interest savings and cash flow before you decide. In summary, start by validating your emergency fund, then choose your path. Pay off if you can keep sufficient reserves, refinance if you need to preserve liquidity, or wait strategically while you strengthen your profile. If you are preparing to buy a home, pay special attention to your debt-to-income ratio and cash flow. Always quantify potential savings using real quotes and calculators before making a decision. Ultimately, choose the path that best clears your runway toward larger financial goals. As we close, thank you for watching. If you found this valuable, please like the video, share it with someone wrestling with a high-rate auto loan, and subscribe for more practical money guidance. In the comments, tell us your plan. Are you paying off, refinancing, or timing your move before a mortgage? Your story could help others. See you in the next one.